Welcome back. Well, you're watching Taking Stock, the Fear Factor, and me and Sonia are here at Taj Lands and taking stock of what's been a brutal week for stock markets. Our guests are NAVNEET MUNOT and also JAYESH GANDHI. So let's carry forward that discussion. What if, we see because of China or because of US markets, any kind of major accident? We've seen, for example, Brent crude now below $30. NYMEX also is below $30. What if we see some of the sovereign funds defaulting or, seeing big redemption pressure? Is that a risk which the market has fully factored in?
Which is already happening. The world has to realize that an oil at $100 and oil at $30, a large part of the wealth is actually shifting from the oil producers to the oil consumers. Now think from a macro perspective, is it good for or bad for India? We're getting worried that some outflows can come from sovereign wealth fund. But just think of it, how much money this country was sending overseas, which will get invested here. This will be in my wallet. I may use it for consumption. I may start saving a little more, which will get invested in the country. Is it a good news? Is it a bad news? If the world is less growth potential, the another thing you have to think that this time the commodity fall is more driven by a higher supply. This is not a completely demand destruction. Because so much of steel capacity has come up. Because so much of new oil, shale, alternative energy is playing a role, which is a good thing.
But that
the
also
world goes through some of those.
Earnings recovery at risk, Navneet, right? I mean, is that not a risk then?
As I said that last year, why some of our portfolios could deliver better returns, because you need to be conscious about where it's going to add to the earnings and where it is going to the earnings are going to get depressed.
It's the kind of exposure that these metal companies have to banks, right? Wouldn't you worry about that? I mean, the kind of increase in NPAs.
That's a worry. Isn't it getting reflected in the valuations?
But who is to say that these banks don't fall more?
Yes, one can always argue how much of that is already in the price, and then you adjust it for the franchise value, and the market sometimes forget the longevity of some of these businesses. On the metals, I think there were some actions expected from the government to stabilize situation in some of the particularly steel. Maybe at some point in time that is likely to happen. Some of the other governments in the world are doing to protect their domestic industry. Maybe our government will have to do a little more, and I think that then things should be okay. But that's a worry. So there are worries on the global account. On India account, one of the larger the balance sheets going into stress, creating a systemic risk for the timing is definitely a risk, and I think that's reflected in the panic that we are seeing in the market.
Yeah. Where do you think this market is going to find leadership to go back towards those previous levels of 9,000 or so?
Well, difficult for me to answer the question stock specifically. Yeah. But if you see the earnings chart of say FY 2016 or even FY 2015, it's totally skewed. You have a set of companies which are showing earnings in 20% plus range, and you have another set of companies in sectors which are showing earnings in the minus 20% range. This large variation, large differential in earnings outlook needs to narrow. And that is where when you will start seeing earnings growth coming back, where the hit that the indices are taking because of lower earnings in commodities and some of the other sectors needs to subside. And obviously we have other sectors like consumers, etc., discretionary, etc., or pharma or IT or whatever those other sectors are, those showing us good growth. And that is what I think will happen we'll start seeing in 2016-17. The reason why we've not seen in last 2 years has been because of the big collapse in commodities. When the oil went from 100 to 60, we thought that is it. From 60 it's gone to, so it's halved again. So from 100 it went to 50, it's half, and then again it's halved again. Now, you could always argue that, look, from 30 can it go to 15? Yes, it can. I mean, nobody can really dispute that. But if that doesn't happen, and if we have broad commodity stabilization at these levels, okay, then our sense is that next year would be when you will see more normalization of earnings, and when that happens, you will see quite a few sectors which will take leadership. Oil and gas is a good example, because there the profits are coming back in a big way, very, very significant way. Would there be benefit for domestic companies consuming some of these metals and so such as consumer discretionary, autos, etc., etc. Then we have other economic factors which will boost demand because of say, a 7th pay commission and a whole lot of other government programs which are happening. So you have construction companies and those kind of sectors, infrastructure-led sectors, which will really benefit. So you'll definitely find a lot of value in a lot of companies and sectors which will start demonstrating earnings growth.
Okay.
And so that's what you should focus on. Yeah.
So that is one theme that both of you have spoken about, that this is perhaps the best bargain you've got in a very long time, so take advantage of it. Navneet, Jayesh did speak about some sectors. I'm going to slice through the sectors now. From the large caps, we've seen private banks, capital goods and telecom, two stocks each that have fallen to 52-week lows. All the index stocks, whether it's ICICI and Axis, BHEL and L&T, and Bharti and Idea. Now, between these three sectors, private banks, capital goods and telecom, where do you see the highest value?
Again, so if I can put in a different manner, that why we could do well last year was that if you avoided corporate balance sheets which have a lot of leverage, lenders who have a lot of exposure to these people, and commodities. Broadly, I think these 2 or 3, I think if you avoided, you could do well. Maybe at some point in time, valuations for some of these will also become attractive. So some of the names that you talked about didn't have the place in the portfolio last year, but maybe some of them are reaching levels where we need to seriously think about whether this is a good time to get in, and relative to some of the other stocks.
Corporate balance sheet is ICICI Bank. So am I getting that
corporate
right?
lenders. So the retail lenders have done phenomenally well, and including the NBFCs and some of the private sector banks have done exceedingly well. And while the corporate balance sheets, for the right reason, because there is a lot of stress still in a part of the corporate balance sheet, and wherever you had that higher exposure, I think the stress is very visible. But I think at some point in time, most of it will get reflected into the price. Just go back and think about, and I keep thinking again and again, even my team, I keep them reminding about the October 2008 to March 2009, and just think and go back and watch that whole movie again, how it kind of started and how it ended, and where we were in July 2009. We shouldn't lose sight of that.
We shouldn't lose sight of that. We have just 30 to 40 seconds left in the show, so let me just take one last question from both of you, and I would appreciate a quick answer. Navneet, to begin with, do the markets go back to all-time highs in 2016, or is that a level that's going to be tough for the markets to achieve?
So I don't know whether in next 11 months or so, but I think, yeah, probably 15 or 18 months. Again, I think the stock picking is far more important than the index level. There are lots of structural factors for that, but since we have 30 seconds, maybe we can discuss some other time.
Okay, Jayesh, okay, let me expand the time horizon, not just 2016, but middle of 2017. Do you see the market going back to all-time highs?
I would like to believe that they could. Okay. And you'll be surprised how quickly the markets will recoup back. We've seen that in the past as well, like the time that Navneet mentioned about 2009. Very quickly some of these concerns will disappear, and we will start seeing markets flying. So investors should keep the hope and keep the patience. This business is all about keeping the discipline and keeping your faith in the stocks and the funds that you invest in.
Okay, so keep the hope and keep the patience, and the markets will bounce back. That's the view from the fund managers. But the market over the last 2 weeks or so has given a big scare. And a lot of investors could be soothed by hearing what they've heard today.
Oh yes, and as they said, the biggest wealth is created when there's blood on the street. So on that note, thank you gentlemen for joining us. With that, it's a wrap on this edition of Taking Stock. Thanks for watching.